Welcome back to Trading Day. We're tracking oil. It's hanging around $83 per barrel as it recalculates geopolitical risk premiums. Our next guest says headwinds could push crude down another 2 to 4%, but the risks are still skewed to the upside. Rebecca Babin, senior energy trader at CIBC Private Wealth, joining us now. Rebecca, thanks so much for joining us. Let's just talk about all the factors that led to this most recent downdraft and why we could see a couple percent more downside.
Yeah, so I think generally traders or investors were very well positioned for the escalation that happened in the Middle East. And that was through options positioning. There was an explosion of call option volume in the last 2 weeks leading up to what was the Israeli response to Iran's attack on Israel. And that really caused an unwind of all of those extreme tail hedges when we did not realize the worst case scenario. So we've seen kind of hedges being unwound, and we've also seen the macro kind of hedge fund community look at what is driving crude higher and saying, okay, we're in this trade for the reinflation trade. There's a lot of geopolitical risk premium built into this. Maybe I need to take some profits here and reestablish those longs when we're trading closer to fundamentals, as opposed to the $5 to $7 of geopolitical risk premium that's currently priced in. So I think the market was positioned for the event. And I think secondly, we've seen some of the fundamentals softening, particularly the high frequency data in China has started to slow down. And we've seen analysts really ramp up their expectations of demand growth this year. So we've got a situation where expectations are high, and now the market needs to deliver. And the delivering on high demand growth is still kind of uncertain. And I think there's been a little bit of hesitancy to continue to buy crude close to that $90 level in Brent, as we feel like we're closer to the ceiling than we are to the floor.
That's really interesting analysis, talking about the dollars that are on top of the fundamental price. So as you see it right now, what is the fundamental price excluding those geopolitical risks?
Yeah, I think the fundamental price is $80 Brent, kind of maybe $82 Brent, and the high 70s in WTI. I think if we look at demand growth of 1.4 to 1.5 million barrels a day, which is very solid, and supply growth looking at around 1 million barrels a day, we do see the market in a deficit. So that's a very healthy price. We would see inventory draws, but we don't see excessive inventory draws. And keep in mind, if we get into the 90s, we have a ton of spare capacity on the sidelines from OPEC and OPEC Plus that can be brought back online, that wants to be brought back online. They have held their supply back for so long and ceded so much market share to U.S. producers, to Canadian producers, to Brazilian producers, to Iranian barrels. They do want to try to regain some of their market share, and they will use that opportunity in the 90s. So I think 80 Brent, 77, 76 in WTI is where fundamentals are strong, we're supported, and at these levels, we're much closer to that ceiling than the floor.
Well, I think that's really interesting, because if you're looking at buying an energy stock today, you do want to kind of know what is that floor outside of all the geopolitical risks that I'm going to see it. And that's like still a very robust price for most energy producers on the planet.
It's a great price for energy producers on the planet. And the other thing about that price is it's good for producers. They'll continue to produce, but they're not going to overproduce. They're not going to go well over their skis and start pumping away. It's also a very fair price for consumers. So when we start to breach above 90 in Brent, we start to see consumers respond to prices at the pump, to emerging markets who are also impacted by the dollar. So that's a price where we don't see demand being hit. We have producers who are active, but not overly active, and it's a nice equilibrium. When we start to get higher and higher, obviously the age-old saying of the best thing for high prices in commodities is high prices. That's what makes it go lower. It does tend to be true. obviously there is a geopolitical element here that has not fully resolved. So there's going to continue to be a premium in the market for that. I think it's come down from $10, kind of closer to $8. It could probably continue to fade closer to $3 to $5 over the coming months, depending how things play out. And I think the real buyers, the people looking at fundamentals, really start to engage when we get closer to 80 in Brent.
And is the crude calculus of the geopolitics basically such that, anytime things look peaceful, you get a couple dollars off, and anytime things don't look peaceful, you get a couple dollars on? I mean, is that how people are trading right now?
So a little bit. I think that when you have periods of limited headlines, right, it becomes not top of mind anymore. It doesn't mean the risks are not there. It just means it's not a constant barrage in your face all day about those growing risks. And so you might not see as much of that speculative bid kind of driving crude higher. And on the flip side, when you have the headlines, even if it doesn't mean supply is going to be impacted, as is most likely the case in the Middle East, you see the reacceleration higher just on the fear of it and the fact that it's so top of mind for everyone. I think those couple of dollars here and there kind of do respond to that headline risk. The real risk under the surface, I do think, is closer to that $4 to $5 of geopolitical, and we've kind of extended to that $8 or $9 where we're at now.